Bismillahirrahmanirrahim. Selamat datang ke Bank Negara Malaysia. Pada sidang akhbar ini, pertumbuhan ekonomi negara serta perkembangan moneteri dan kewangan pada suku keempat tahun 2014 akan diumumkan. Saya juga akan memberi taklimat perkembangan terkini keadaan ekonomi dan kewangan negara. Ekonomi negara mencatatkan pertumbuhan yang lebih kukuh pada suku keempat, iaitu sebanyak 5.8% berbanding dengan 5.6% pada suku ketiga tahun 2014. Ekonomi negara terus disokong oleh permintaan dalam negeri yang kukuh. The global economic activity continued to expand at a moderate pace in the fourth quarter of 2014, with diverging growth momentum among major economies. The US and the UK economies showed broader signs of improvement, while economic activity in the euro area and Japan was subdued amid persistent structural constraints and weakening business and consumer sentiments. Growth in the Chinese economy was sustained in the fourth quarter at 7.3%, in line with the policymakers' objective of rebalancing the economy to a more sustained growth path. And in the region, economic activity continued to expand, supported by domestic demand and the recovery of exports. The Malaysian economy registered a higher growth of 5.8% in the fourth quarter of 2014, driven mainly by continued expansion in private sector spending. On a quarter-to-quarter seasonally adjusted basis, growth momentum increased to 2%. And for the year of 2014, the Malaysian economy advanced by 6%, compared with 4.7% in 2013. Domestic demand continued to be the anchor of growth in the fourth quarter, driven by stronger private sector expenditure and a turnaround in public sector spending. Private investment growth also expanded at a faster pace of 11.2%, while private consumption growth increased to 7.8%. So we saw the growth in consumption activity. Public sector spending registered a positive growth of 0.6%, reflecting a slower decline in investment amid the moderation in public consumption spending. On the supply side, growth in the fourth quarter was supported by all the major economic sectors. The services sector registered a growth of 6.4%, with the expansion across all subsectors of the services sector. The manufacturing sector recorded a sustained growth of 5.2%, supported by stronger performance in the export-oriented industries, particularly the electronics and electrical clusters. The construction sector expanded by 8.7%, driven mainly by non-residential and residential subsectors. The agriculture sector, however, contracted by 2.8% amid sharply lower palm oil production caused by the floods in the eastern states of Peninsular Malaysia. The mining sector expanded strongly by 9.6% due to higher crude oil production, and this is despite the decline in crude oil prices in the fourth quarter. Malaysia's oil production increased by 13.6% to 665,000 barrels per day during the quarter. Turning now to the demand side, private consumption registered a stronger growth of 7.8%, and this growth in private consumption was supported by stable market labor market conditions, and positive wage growth in the domestic and export-oriented sectors. Going forward, the lower oil price is expected to raise household disposable income by approximately 7.5 billion for the year 2015. Inflation is also projected to be lower than earlier estimated, thus providing further support to consumption activity. The fourth quarter labor market conditions remain stable with low unemployment rate of 2.8%. And this is described as the economy being operating at full employment. 87% of total employment is in the manufacturing and services sector, and the commodity sector only account for 13% of total employment. The slowdown in the oil and gas sector is therefore not expected to have a major impact in the overall employment situation. Private investment expanded at a faster pace at 11.2%, underpinned by capital spending in both the services and the manufacturing sectors, which accounts for more than 3/4 of private investment activity. For 2015, the lower oil prices is expected to weigh down on investment activity in the oil and gas sector. However, with this sector only accounting for 20% of total investment, the assessment is that investment, that is gross fixed capital formation, will continue to remain firm, supported by investment activity in both the services and the manufacturing sectors. Malaysia also continues to receive a steady inflow of foreign direct investment, reflecting sustained foreign investors' interest in Malaysia. Net foreign direct investment inflows increased to 10.2 billion ringgit in the fourth quarter of 2014. For the year as a whole, foreign direct investment amounted to 35 billion ringgit. Foreign direct investment inflows is also well diversified, channeled mainly to the manufacturing, services, and mining sectors, and it's particularly in the financial and wholesale and trade, retail trade subsectors. The moderation in export growth to 0.5% in the fourth quarter of 2014 reflected the decline in commodity exports and resource-based manufactured exports, and to some extent it reflected the higher base recorded in the fourth quarter. However, the electronics and electrical exports continued to improve in the fourth quarter, registering a stronger growth of 5.5%. compared to the third quarter of 2.7%. Gross imports also grew at a faster pace of 4.6% in the fourth quarter, reflecting higher imports across all major categories. As the expansion in exports was larger than imports, the trade surplus in the fourth quarter improved to 21.5 billion ringgit compared to 16.8 billion in the third quarter. Overall, Malaysia recorded a higher trade surplus of 83.1 billion ringgit in 2014. Malaysia's export structure is highly diversified across products and markets, and this reduces the risk of a slowdown in any specific export market and hence to the overall export performance. The current account recorded a surplus of 6.1 billion ringgit or 2.3% of GNI in the fourth quarter of 2014. However, higher deficits were recorded in the services and primary income account. For the year 2014 as a whole, the current account balance was higher at 49.5 billion ringgit, or at 4.8% of GNI. And this is very important, of course, that Malaysia continues to have a strong surplus in its current account. For 2015, the current account is expected to remain in surplus, albeit narrower. Despite the expected low oil prices, the surplus in LNG and CPO exports will remain sizable. In addition, manufactured exports are expected to continue to benefit from the recovery in some of the major industrial countries, in particular the United States. Headline inflation moderated to 2.8% in the fourth quarter of 2014, and the decline in the headline inflation during the quarter was attributed mainly to the low inflation in food. For 2014, inflation increased by 3.2% compared to 2.1% in 2013. The downtrend in inflation is expected to continue going forward amidst the lower global oil and commodity prices. The lower inflation is expected to benefit households through savings from lower fuel prices in particular. With the implementation of the managed float pricing mechanism for fuel, the outlook for headline inflation would be subjected to the movements in the oil price. However, the more moderate demand conditions would contain the pressure on the underlying inflation. Amid steady growth prospects and with inflation expected to be lower than earlier anticipated, the MPC decided to maintain the OPR at 3.25% on 28th January this year. At the current level, the stance of monetary policy remains accommodative and supportive of the economy. The MPC will continue to assess the external developments and their implications on our economy, and the MPC will also continue to monitor the risks of destabilizing financial imbalances. This is to ensure that the monetary policy stance is consistent with the sustainability of the growth prospects of the Malaysian economy. On the foreign exchange, all regional currencies, including the ringgit, have depreciated against the US dollar since September 2014, and this is the result of the strengthening of the dollar, which has been on an uptrend following the expectations of the normalization of monetary policy by the Federal Reserve Bank amidst the steady recovery of the US economy. The ringgit, however, experienced a larger adjustment, reflecting market sentiments surrounding the impact of the lower oil prices on the Malaysian economy. The concerns related to the global growth outlook and significant decline in oil prices since September of 2014, and this has led to large non-resident portfolio outflows from Malaysia amounting to 18.6 billion US dollars, which has contributed to some of the adjustment in the ringgit. I should mention, of course, that these kind of outflows have been seen before, as I will discuss later, during the announcement of the tapering, and then during periods of deleveraging during the global financial crises. It is important to note that we have experienced this situation of large capital outflows before. During the global financial crises, there were outflows of 39.3 billion during the period 2008, March of 2008 and March of 2009. And the second period we saw such outflows were during the first indications of tapering by the Federal Reserve Bank and this was the period between May and August of 2013, where the amount of the outflows was 19.1 billion US dollars. And during these periods of large reversals, including in the recent period, our domestic financial markets remained orderly. There was no disruption in financial intermediation, and more importantly, there was no dislocation to the underlying economic activities. Our ability to manage this volatile capital flows is supported by the availability of a wider range of policy instruments, the increased flexibility, and sufficient buffers. Our banking system is also solid and strong, and the financial markets are well developed to absorb and intermediate such swings in capital flows. Going forward, capital flows and the ringgit exchange rate will adjust to reflect Malaysia's strong underlying fundamentals when global financial markets stabilize. During this adjustment process, Bank Negara Malaysia will continue to ensure that the domestic foreign exchange and financial markets remain orderly. The short-term external debt reflects Malaysia's increased regional integration, and this is an important phenomenon that is likely to continue going forward. And it also reflects the more developed financial markets in our country. Most of Malaysia's short-term external debt comprises of banking sector external liabilities. Additionally, it also reflects non-resident holdings of ringgit-denominated debt liabilities. In other words, our external debt liabilities are about half of it is ringgit-denominated. So in assessing the risks associated with short-term debt, a number of considerations need to be taken into account. The liabilities of the banking sector is largely due to intra-group placements by overseas branches of domestic banks and represents a small share of the bank's total funding. Of course, we all know that most of the bank's funding is from deposit liabilities. The non-resident holding of money market instruments, mainly comprising of Bank Negara Malaysia's bills and notes, and the risk remains well contained as the instruments are part of the bank's monetary policy operations to absorb excess liquidity from the financial system. And finally, the remaining short-term external debt constitutes mainly trade credits and short-term intercompany loans, which are largely backed by export earnings. So as at end January 2015, the international reserves remain ample at 110.6 billion US dollars, and these reserves are sufficient to finance 7.9 months of retained imports and covers 1.1 times the short-term external debt. Financing of the economy also remains healthy during this period, with no disruptions in financial intermediation. Financing to businesses continued to be strong, growing at 12.7%, and this is from both the banking system and the development financial institutions to SMEs as at end 2014. Taking into account financing from both banks and non-banks, household debt growth has continued to moderate to 9.9% as at end December, and as intended following the measures to curb pockets of excessiveness. And we are pleased to note that this moderation in household indebtedness has been since 2010, when the growth of these loans were more than 15%. The PDS market, that is the private debt securities market, which is the main source of capital market financing, saw relatively steady PDS issuance amounting to 21.2 billion ringgit during the quarter, despite the volatile market conditions. Going forward, financing will continue to remain supportive of economic activity, and our assessment indicates that there will be continued availability of financing for businesses, especially for SMEs from the banking system and from the development financial institutions. Additionally, funds raised from the capital market will remain high given the committed investment projects in the pipeline. On liquidity in the domestic financial system, this continues to remain ample. Outstanding surplus liquidity with Bank Negara Malaysia remained high at 269 billion ringgit as at end December, despite the recent unwinding of liquidity following the outflows. And this is important. So we have sufficient resources to unwind further should there be further outflows, to ensure that there will be constant ample liquidity conditions. Of the reduction in the surplus liquidity in the fourth quarter, more than a third was due to the unwinding of non-resident holdings of Bank Negara securities, which has cushioned the impact of non-resident outflows on the private sector liquidity and volatility of prices in the financial markets. Private sector liquidity, as measured by broad money or M3, continued to grow, rising by 7% as at end December 2014. The banking sector exhibited maturity and resilience throughout the previous episodes of capital flow reversals, as well as during the period of heightened market volatility and uncertainty. Domestic financial stability has also been preserved, and the financial system has continued to function in an efficient and effective manner to support our economy. The resilience has been similarly demonstrated during this recent sell-off by non-residents since December of last year. Capitalization of the banks has remained well above the regulatory requirements. Liquidity continued to be ample, with comfortable levels of buffers being maintained at the institutional levels to facilitate continued provision of financing and financial services. Banks have also continued to remain profitable. Despite the periods of heightened volatility, orderly conditions in the financial markets were maintained, and public confidence of the domestic financial system has remained intact. The Malaysian government security yields have also moved at most by 50.4 basis points during the recent period. The banking system is well supported by deposit-based funding, which is more stable, and banks are generally not reliant on interbank funding. The banking system recorded a loan to deposit ratio of 86.7% during the quarter. Malaysia will implement liquidity standards that are consistent with Basel III beginning June of this year, and in anticipation of this, there has been some increase in competition observed in the deposit market, with deposit and interbank rates trending higher towards December of 2014. The liquidity buffers of the banking system, however, remains comfortably above the minimum required liquidity coverage ratio. This is supported by high liquidity of liquid assets currently held by banks, which include MGS and highly rated bonds and sukuk. Transitional arrangements provided under the new liquidity standards will facilitate the adjustment by banks to the new standards. This includes a gradual phasing in of the minimum compliance levels over a 4-year period, and in January 2015, the bank has issued further clarifications on rules pertaining to the liquidity coverage requirement. This has helped ease the pressure on CLIBOR, which recorded a decline from the peak of 3.87% on December 15th, 2014 to now 3.82% on 9th February 2015. The debt servicing capacity of households remains sound, and this is supported by favorable income and employment conditions and sound aggregate household balance sheets. Growth in household debt has both from banks and non-banks has now sustained its moderating trend over 2 consecutive years. Household debt increased by 9.9% in the fourth quarter, and this continues to be largely attributed to the moderation in growth in personal financing by non-banks financial institutions, which more than halved to 5.3%. The quality of new household loans also have continued to improve. And also I want to mention that AKPK, Agency Counseling Pengurusan Kewangan, that is the agency that provides counseling and debt management programs, continues to provide regular assistance to help households manage their debt. And to date, AKPK has helped more than 300,000 individuals to manage their financial commitments. Credit risk from exposure to businesses remain largely unchanged, supported by financial and balance sheet strength of businesses. The aggregate leverage position of businesses remain low at 42.7% and is supported by a strong interest coverage ratio of 6.2 times. The annual growth of domestic borrowing by businesses rose to 8.5%, with funding remaining broad-based in line with planned funds raised by strategic and capital-intensive industries to finance economic activities. External borrowing of businesses declined by 0.5% at the third quarter of 2014, and these are the latest figures that we have, with the bulk of the borrowings comprising intra-group funding by multinationals for operations in Malaysia. Overall, delinquency trends also remained low and stable during the quarter. So if we look at the conditions for domestic financial stability, it is expected to be preserved throughout 2015, despite the more challenging and uncertain operating environment. Regular and periodic stress tests by the bank indicate that our banking institutions are well positioned to weather highly severe financial market and macroeconomic conditions. Banks' total capital ratio and common equity tier 1 ratio is estimated to remain above the 10% and 7% respectively, well above the regulatory requirements. And the estimated potential shortfall for US dollar liquidity under stress conditions is limited at less than 5% of the bank's international reserves. So to conclude, going forward, the external environment will continue to remain highly uncertain, with the divergence in policies across key economies in the world, and this is expected to remain. The volatility will therefore in crude oil prices, capital flows, and international financial markets is therefore expected to continue. The Malaysian economy, however, has a diversified economic structure supported by strong fundamentals, and this includes low inflation, favorable employment conditions, low external debt, and ample international reserves. The banking system also remains strong and is well capitalized, while financial markets are deep and well developed. The Malaysian economy, therefore, is expected to remain resilient in the face of these uncertain and challenging environment, and is expected to remain on a steady growth path. That concludes the presentation, and we are pleased to respond to questions that you might have.